Hi, my name is Richard Un. I'm the Tax Director of Shinewing TYTO. First of all, I'd like to thank StarProperty for inviting me to present this section on how the Budget 2023 affects property investors and owners. Of course, there were many budget proposals which was presented by our Prime Minister and also the Finance Minister recently on the Budget 2023, which affects a lot of parties. But for the purpose of this presentation and in the interest of time, I will only limit it to the changes that it will affect property investors, property-related, and individuals in particular, right? And before we proceed, of course, we have the usual disclaimer on the screen here. During the Budget 2023 announcements, there were many proposals put forward. I've broken down my contents of this presentation into 5 particular sections, which are individuals, company, LP, or corporate taxation, RPGT, stamp duty, and others. And the topics which will be covered in this presentation is as shown in this particular slide. The first section I'll cover will be individual tax. First, income tax relief for medical treatment expenses. Currently, we enjoy up to 8,000 tax relief for medical expenses for serious diseases, expended on self, spouse, or child, fertility treatment, vaccination, food medical checkup, including COVID-19 detection tests and others. From YA 2023 onwards, it is proposed that the tax relief be increased to 10,000 ringgit maximum. And the scope is also expanded to include the intervention expenditure for autism, attention deficiency hyperactive disorder, ADHD, global development delay, intellectual disability, Down syndrome, and specific learning disabilities. But however, this particular sub-area, the relief is only limited to 4,000 ringgit. So what do we mean by all these sub-areas are all highlighted in red under the sections here below? Right? The next slide will give you a clearer picture. As you can see from the slide here, what we enjoy currently is 8,000 ringgit medical expenses. Included therein is this, you can claim serious diseases, fertility treatment, vaccination expenses, and full medical checkup, including COVID-19 and others. But however, for vaccination expenses, it's capped at 1,000 ringgit. Full medical checkup and COVID-19 and others is also 1,000 ringgit max. From 2023 onwards, the relief cap has been increased to 10,000 ringgit from 8,000 ringgit. The internal cap for vaccination expenses still remains at 1. Full medical checkup still remains at 1. And the new expansion scope, you get a maximum of 4,000 ringgit. Next income tax relief for individual is the voluntary contribution to EPF. Currently, for employees and self-employed, contributions to approved schemes or voluntary contribution to EPF, not including private retirement schemes, you get a maximum of 4,000 ringgit tax relief. We will also get another relief for life insurance premium or takaful contribution of 3,000 ringgit. Now, what has been proposed in 2023 and moving forward would be for contribution to approved schemes and voluntary contribution to EPF, it still remains at 4,000 each. However, for good news for the self-employed, whereby if a contribution is in excess of 4,000 ringgit and there's still limit available under your life insurance premium or takaful contributions, this voluntary contribution can be included under this category of 3,000 ringgit here, right? So meaning to say that YA 2023 moving forward, under life insurance premium or takaful contribution, it has been expanded to include additional voluntary contribution to EPF. Altogether, these 3 items can make up the 3,000 ringgit relief under this particular category. Childcare center or kindergarten fees. This particular relief of 3,000 ringgit is given to taxpayers who enrolled their children aged up to 6 years in age in childcare centers or even with kindergartens. This relief, however, is supposed to be valid only up to YA 2023. The proposal is that this particular relief is be extended for another year, meaning to say you can still get to claim this relief in YA 2024 as well. Next, with all good news comes some bad news as well. There are some personal reliefs which are due to be discontinued from YA 2023 onwards. First on the list is the contributions to the SSPN of 8,000 ringgit. Next is the special lifestyle relief of 2,500 ringgit. This special lifestyle relief of 2,500 shouldn't be confused with the standing 2,500 lifestyle relief that we have every year. This 2005 was introduced during the MCO period for the purchase of personal computers, smartphones, and tablets. And of course, the other relief that will be discontinued is the domestic travel relief of 1,000 ringgit, which was also introduced to encourage local tourism after the MCO period. But then again, after listening to the grievances of the rakyat, the government has decided to reinstate SSPN. And this relief will still be valid for 2 more years, which is YA 2023 and YA 2024. Up next is the changes to the income tax rates for individuals. For YA 2023, moving forward, it is proposed that for the M40, for bands of income between 35,000 ringgit to 100,000 ringgit chargeable income, there will be a 2% tax reduction, resulting in a maximum tax savings of about 1,300 ringgit for the M40 group. While for the T20, for the chargeable income bands between 100,000 up to 1 million, there's a 0.5% up to 1% increase in taxes. So potentially for the T20, you will see a 10,950 ringgit increase in your tax bill from YA 2023 moving forward. Next, I'll touch on this major change to corporate income tax, which involves the micro, small, and medium enterprises, MSMEs. Currently, MSMEs, they enjoy a preferential tax rate of 17% on the first 600,000 of the chargeable income, and the balance will be taxed at 24%. Now, from assessment year 2023 moving forward, what the government is planning to do is to introduce a new band here, which is for the first 150,000 of the chargeable income. Instead of being taxed at 17%, MSMEs, they will be taxed at a preferential rate of 15% instead. Then only the balance between 150,000 and 1, right up to 600,000 ringgit, will be taxed at the 17% tax rate, and the balance at 24%. So what does this mean for MSMEs? Well, from this proposed change in the tax rate, MSMEs stand to save up to 3,000 ringgit on the first 600,000 of their chargeable income, which is a good thing. May not look very significant, but still a savings nonetheless. However, if you put this side by side with the tax that a non-MSME has to pay, then the tax savings will become even more significant. Because you must remember that non-MSMEs, they are taxed at a flat rate of 24%. So they don't enjoy this 15, 17 tax bracket at all. Everything is taxed at 24%. So meaning to say, because of this change, then the MSMEs stand to save up to 45,000 ringgit more as compared to those non-MSMEs. But one thing we have to pay careful attention to is the definition of a MSME for tax purposes. Well, a MSME is defined as follows. Important keywords here will be paid up capital of 2.5 billion and less. And the other one, which is highlighted in orange, is gross income from source or sources consisting of a business, not exceeding 50 million, consisting of a business. So, to all companies having paid up capital of 2.5 billion and less automatically become a MSME. Let me explain further in the following slide. Well, we have this thing called business and non-business sources of income of a particular company. Non-business source comprised mainly of gross investment income from rental, dividend, and interest. And business source, you're going to have rental with supporting services, trading of products, management consultancy fees, and all others. Those are really business. These are business, these are not. Now, if you will notice from these non-business sources, rental, dividends, and interest, typically, this is the income of what an investment holding company would have. So, if you're an investment holding company, you do not qualify for MSME tax rates because you do not have a business source, and therefore you're taxed at a flat rate of 24%. This is the typical property investor's conundrum because we tend to not only invest in properties under our own names, but we invest in properties through a company, be it for financing purposes or even for succession planning purposes. But once you have properties in a particular company, then that's where the problem begins. The tax definition of investment holding company is a company whose activities consisting mainly in the holding of investments, and not less than 80% of its gross income is derived from the holding of those investments. While business of holding of investment is unique, where the rental that you earn from that particular property, you are actively providing maintenance services or supporting services to it. Say, for example, Airbnb perhaps. But most of the property investors will fall under this general category here, because the rental source that you're receiving is purely passive, and you do not provide any maintenance services or support services. So this is where the investment holding company trap comes in. The investment holding company traps look something like this. If non-business sources, regardless of whether it's taxable or exempt, and business sources, with this subtotal of A and B here, so long as A over C is more than 80%, you are an investment holding company for income tax purposes. And therefore, you will not qualify for the MSME income tax rate, that is for certain. So most of us will fall under here. So a quick point to note is that if you do happen to have some income from these three sources here at the moment, or you have some sources of incomes elsewhere, you may need to consider your tax strategy by seeing whether some of this income could be increased or included in your company, so that this portion exceeds 20% of the company's total income, and therefore the A divided by C falls below 80%, and hence you are no longer an investment holding company. So interesting to note is, from all these changes in the income tax rates for individuals and companies, there's this huge disparity or difference between the taxes that the individual has to pay as compared to a company or LP. As you can see from the graph here, the red line representing the tax that the company or LP has to pay is 15% on the first 150,000 of the chargeable income, 70% on the next up to 600,000, and balance at 24%. While an individual pays 0% tax rate right up to 30% tax rates, so which is even higher than the tax rate of a company. So a company is even more advantageous as compared to an individual after a certain income level. So which gives us something to think about here. Next, I'll touch on the proposed changes to the real property gains tax. First, we'll touch on the transfer of real estate ownership in case of divorce due to court order. But before we go into the details of the proposed change, let me give you a little bit of background on the tax, RPGT tax, which is involved here. RPGT is, of course, chargeable on gains arising from a sale, disposal, or even the transfer of real property, including shares in real property companies. But there are situations whereby if you were to transfer a property, it can be treated as a no gain, no loss situation, meaning to say that the selling price is deemed to be the same as the acquisition price. Therefore, you suffer no gain, no loss, and the transferor do not have to pay any RPGT on it. And those situations arise under the following circumstances: transfers between husband and wife, transfers between parent and child, and even transfers between grandparent and grandchild, provided that the donor is always a citizen. Okay? So now, this is where the problem comes in. The no gain, no loss situation comes into play where it's a transfer between husband and wife, but it doesn't cover the case of a divorce where the husband and wife relationship no longer exists. So the change in law is proposed to be in this manner. It has been expanded, right, to include the case, in the case of a divorce, whereby it's due to a court order, any transfer of property from one party to another due to this court order is deemed to be the same as its acquisition price, i.e. no gain, no loss. Therefore, there's no RPGT suffered. If not previously, then in the case of divorce, where there's a transfer of property, the person transferring the property, unfortunately, does not get to enjoy this and will be taxed according to the rates as stated here, under normal sale situations. The next part I'll cover is stamp duty. Stamp duty exemption for the purchase of first residential property. Currently, full stamp duty exemption is given on instrument of transfer and loan agreement executed between 1st January 2021 to the 1st December 2025 for the first property purchase valued up to $500,000. Anything between $500,000 and $1 million, there's a 50% exemption or remission of the stamp duty given on the instrument of transfer or loan agreement, but it must be executed between 1st June 2022 to the 1st December 2023. Okay. The proposal is now that stamp duty imposed on instruments executed for the purchase of first residential property, be it the instrument of transfer or loan agreement, valued between $500,000 to $1 million, is now given a 75% exemption instead, up to the 1st December 2023. Meaning to say more savings for the first home buyers. And this is a period, the 1st December 2023 deadline. This is a period whereby it's, we need to really take advantage of, particularly for the first home buyers. Next, I'll touch on the proposed change to the stamp duty treatment for transfer of property by way of love and affection. Currently, effective on 1st January 2019, the rate of stamp duty on instrument of transfer is shown in the table above based on the value of the property. Now, in the case of transfer of property between parent and child of Malaysian citizenship, a 50% remission of the stamp duty will be given. Of course, stamp duty will be calculated based on this particular table here. However, the total, a 50% remission given, so that the party will only have to pay the other 50%, the balance 50%. Now, moving forward, the proposal is that the scope, the people involved, and also the rate will be increased. So instead of just parents and children, grandparents and grandchildren, where the transfer is made by way of love and affection, this remission will also apply. And besides that, the rate of remission has also increased. Meaning to say, for the first 1 million of the property's value, there's a 100% exemption. Then, any amount in excess of that 1 million, a 50% of stamp duty will be remitted. So, important point to note here again is that the recipient must be a Malaysian citizen in order to qualify for this stamp duty treatment. This is the last section of my presentation, which I will touch on other areas which may be of interest to the viewers out there. The first part will be on the proposed new taxes. Under our current tax framework here in Malaysia, there are two types of taxes, which is the direct tax and indirect tax. Direct taxes is under the purview of the LHDN, Lembaga Hasil Dalam Negeri, and indirect taxes, which is under the purview of the RMC, which is the Royal Malaysian Customs. Okay. Under direct taxes, it's split into two: income tax and capital gains tax. Some of you may be asking right now, is there a capital gains tax here in Malaysia? In fact, there is. You may be very well familiar with this RPGT. It's a form of capital gains tax. This is tax on the disposal of real properties here in Malaysia. Now, what has been proposed is the tax on sale of unlisted shares. Meaning to say that if you have shares in an unlisted company, a Sdn Bhd, you hold shares in a Sdn Bhd, and you sell those shares, it is proposed that these shares will be brought to tax moving forward. This is the proposed new form of capital gains tax or CGT. But are you aware that, in fact, for sale of unlisted shares, you may also be subject to tax at the very moment right now? You happen to sell those shares. It involves us property investors again, where the shares that we dispose of are what we call shares held in real property companies, RPCs. Those shares are taxable as it is right now. So as you can see, there is a slight overlap between these two. This is covered under RPGT if the company is an RPC. While this proposed new capital gains tax will cover all other companies which are unlisted. Under indirect taxes, of course, the major branch will be the sales and service tax, but now what is being proposed as well is the luxury goods tax. So the orange ones are the proposed new taxes, and these are the proposed implementation dates. For tax on sale of unlisted shares, is proposed to be implemented from 2024 onwards, and luxury goods tax is proposed to be implemented sometime this year, but the date was not specified. So what does it mean? So what the government has promised during the budget announcement is this: it will be taxed at a low rate, and the introduction of CGT will start in 2024 only. So we have a little bit of time to plan right now in terms of those listed shares that we plan to sell. It's a good time to sell before this particular CGT kicks in. The Prime Minister has made further clarification that he's assured that it will only be finalized upon extensive engagement with stakeholders and will not be introduced on listed shares. So for us who are holding shares in listed companies, if we sell them, we don't have to worry about that. It's not covered under CGT. And also, for those companies which are planning to go for initial public offering or IPO, so long as these unlisted shares has been approved for IPO due to a restructuring process and all that, so all shares held for an approved IPO will not be subject to CGT as well. Under the luxury goods tax section now, in the budget announcement, it was announced that it's applicable on luxury goods on certain value and type. Certain items which was mentioned specifically during the budget announcements was watches and luxury fashion items. Okay, a lot of clarification is still required on this particular aspect as well. The proposed introduction of LGT is sometime in 2023, but the definition of luxury goods is left hanging in the air at the moment because people will be very concerned. What are luxury items here? Will even a high value property be caught under luxury goods? This is yet to be seen. So we have to wait for further announcements to see how it looks like. But in essence, when you talk about luxury goods, the general accepted definition of luxury goods would be goods which are considered expensive, unnecessary, and non-essential. Okay. And finally, voluntary disclosure program. The voluntary disclosure program, which was introduced previously, has now been reintroduced, which covers direct tax and indirect taxes. And these are the areas covered: income tax, RPGT, stamp duty under direct taxes, while sales tax and service tax under the direct taxes. So the period of this voluntary disclosure is between 1st January 2023 to the 1st May 2024. What is exciting to note is that there is a 100% penalty revision given now, instead of the previous voluntary disclosure program whereby there's a 10% tax rate, penalty rate, which will be imposed. But in this particular round of voluntary disclosure program, it has been announced that a 0% penalty will be imposed. However, the tax which is due to the government still have to be paid, right? An important point to note from the voluntary disclosure program is that the disclosure has got to be made in good faith. Meaning you say that you clearly believe that this is all that you have omitted to declare, and you declare, and the IRB will accept it in good faith. Okay, so this is a good time for the taxpayers out there who may have omitted to declare some income, particularly right now in view of the implementation of the foreign source income tax, which is not covered under my section here, it's a good time to review your position and perhaps take advantage of this voluntary disclosure program. 1st June 2023, right up to 31st May 2024. So this ends my section. Thank you very much for your kind attention, and I wish you all the best for the year 2023 and your property investment journey. Thank you very much.